Hello, very good morning and happy Friday to all. I'm Kelvin here again. Welcome to today's Daily Dose of Market Insights. Very good morning and happy Friday. Today will be the 26th of July 2024. So before we jump straight into our Daily Dose of Market Insights for today, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay. All right, so before we jump into the short-term intraday technical outlook of the major cross-asset classes, I would like to share with you all what has taken shape yesterday in terms of the economic data releases, the price movement of the major cross-asset classes, as well as the longer-term, medium-term horizon intermarket dynamics that is playing out in the global markets right now. All right, so let's start with the economic data releases first for yesterday, and as well as today's early Asia session. So what we could see yesterday, one of the key data that we highlighted that we got to pay pretty much close attention to is the US GDP growth data over here. So this was actually a flash estimate. So this is the first flash estimate that the US statistical board released. So Q2 GDP data from US was pretty much of a healthy pace than what market is expecting. So market expecting 2% year-on-year growth, but it came in better than expected at 2.8% and also way above 1.4% in Q1. So if you look at the economic growth in US at this juncture, all right, you go to the 5-year trend, this is your growth rate. So it's pretty much of a healthy bit, still hovering around 2%, okay, on the average since Q3 2022. So what we could see over here is that at the current state of the economic, we call it a status in US, it seems to us that the current high interest rate environment have not really dampened the economic growth in the United States. But however, there are some leading indicator like non-farm payroll data is one of them, and you have the ISM services PMI data that was released around 3 weeks ago back, showing signs of a contraction, and as well as consumer confidence data that is actually inching downwards in the last 3 to 4 months. Yeah, so despite the fact that Q2 GDP is still holding fine, because Q2 is is the past quarter. That means we're talking about data running from April, May, and June. But however, those leading economic indicators are actually on a monthly basis that are showing signs of what I call softness in the US economy. So given the fact that the US Federal Reserve may not be paying so much attention to this kind of lagging releases, but more attuned to their focus on those leading economic indicators that I shared with you earlier on just a few seconds ago. So at the moment in time, despite we see a very strong GDP data for Q2 is lagging in nature, and the Dow of the market expecting for the Fed to actually kickstart a interest rate cut cycle, not hike cycle, still remains unchanged at a rather high odds in the September FOMC meeting. And even there are some voices in the markets that are looking for the Fed to actually initiate a cut by the end of this month. That means on the 31st July meeting instead. But that's not being favorably priced in by the interest rate futures market. So this is what I mean. If you look at the CME Fed Watch 2, after yesterday's release of that rather hotter than expected Q2 GDP data, market still looking at a high chance of a first interest rate cut to come in on the 18th of September FOMC meeting, which is an 87% chance, almost unchanged since the start of this week, which is also close to about 90 to 85%, this range. All right, so market is still expecting the Fed not to actually do anything on next week. That means keeping the Fed funds rate unchanged at 5.25% to 5.5%. Then thereafter, after the first cut on 18th of September, we'll see a slew of 25 basis point incremental decrease on the Fed funds rate. How do we read that? 72% chance, rather high, above 50, that the Fed would engineer another cut potentially on the 7th of November FOMC meeting. So that's right after the US presidential election, a couple of days after that, right, to bring it down to 4.75% to 5%. Then before the year end, also a rather high number of above 50% at 64% odds right now as we are speaking. 18th of December FOMC, another 25 basis point cut at 4.5% to 4.75%. Then thereafter in January, Stampede, then followed by another 25 basis point cut on the 19th of March and on the 30th of April 2025 FOMC meeting. So what we could see over here is there's a high probability right now that market participants in the interest rate futures market, as compiled by the CME Fed Watch 2 on your screen right now, you see the probability that higher chances that the Fed will kickstart a interest rate cut cycle rather than a hike cycle. All right, so at least if you look at from this perspective over here is that there will be potential additional liquidity added into the market as long as the US economy, yes, potentially leading indicators are slowing down, but as long as it did not lead to a potential hard landing or a recessionary scenario, the what you call it, the Goldilocks scenario of stock indices will continue to play out. That means there could be some form of risk-on behavior in the market. But however, we do know that stock market, there's this kind of rotation play taking place. That means there are certain sectors that's going to outperform and underperform. All right, so later I'll touch more about that on the intermarket dynamics. And also with a lower interest rate from the US, finally, we could start to see signs of at least some form of persistence dollar weakening from a longer term perspective. That means we're talking about from a medium term horizon. But that could actually get complicated much after the US presidential election to see who is the winning candidate. And if Trump were to actually come into the office again, so from a longer term perspective, that means i.e. we are talking about perhaps somewhere around middle of 2025 to late 2025, Trump may enact his trade tariffs policy, okay, towards the global economy. And that could actually be much more dollar positive instead. All right, so if you couple that into the bigger picture over here is that, yeah, from a medium term perspective, the dollar may weaken, but from middle of 2025 onwards until the end, if Trump were to actually comes into the White House, potentially we could start to see a strengthening of the US dollar again. All right, so that is more of a longer perspective basis. All right, so now another data on share with you all that released this morning will be the leading Japan CPI data out from the Tokyo region. So for Japan, it's a bit unique. Before the release of the national, we call it white Japan CPI data, they're going to be released about 2 weeks from now or 3 weeks from now for the July number. We have the Tokyo area CPI releasing first, giving a bit of head starts for us to get a gauge of the inflationary situation in Japan. All right, so we see the Tokyo core CPI data actually hovering above the 2% level, which is the healthy level that BOJ wanted it to actually maintain before they actually embark on a more forceful normalization policy. That means, i.e., potentially kicking start another interest rate hike, and as well as further reducing their JGB bond purchase on the monthly basis. So what we could see over here is it went up slightly by 1 basis point to 2.2%. From 2.1% that was printed in the month of June and on par with expectation. So if you look at the core CPI data over here in Japan, so if you look at the 5-year trend, okay, it's pretty much of a healthy rebound over here. Okay, then now if we were to look at the one that is excluding energy, all right, so this one core is only excluding food. If put in core will be excluding energy. Because of the lower energy prices in the last 4 weeks or month or so, we see them continues to actually decline. All right, decline by a fair bit over here. So I would say that if we were to look at these two different metrics of Tokyo CPI data from the core CPI that is excluding only food, but the core excluding food and energy prices are going in a different direction. So given this mixed reading on the Tokyo CPI over here, we may see some signs of hesitance by BOJ to in fact think about potentially hiking in the July meeting, which is next week. So from a market behavior perspective, given the fact that the yen has strengthened by a fair bit in the start of this week, so for the start of today's daily, this week daily dose, we do highlight this potential yen strength coming back. So those who followed our daily dose were able to have a better picture, and I explained clearly why the yen strength came back. And given today's mixed reaction of, or not mixed reaction, mixed data coming out between the Tokyo core CPI versus the Tokyo core CPI, we may see a bit of hesitance by the short-term boost to further push up the yen strength going forward. And do not forget over here is that yesterday's fall on the yen, the intraday low, hit very close to a key medium-term support level at around the 15170, 152 figure level. Later I'll share with you all why this level is very important from a psychological perspective. All right, so and later I'll touch more about that on the intraday movement of the dollar yen. Okay, so that's the fundamental. Okay, so now with that, that covers the current news flow releases in terms of economic data that was released yesterday and today early Asia session. Now let us take a look at how the markets actually performed yesterday in terms of the major US stock indices. So from the major US stock indices, what we could see very clearly, a very interesting rotation play that continues to play out due to the steepening of the US Treasury curve. That's a bull steepening that causes the Dow Jones Industrial Average and the Russell 2000 to actually inch up gains after the prior day Wednesday session throughout the board sell off. So the Dow Jones actually went up by 0.2%. The Russell 2000 is the top performer, up by 1.26%, and the mega cap stock continued to underperform, negative 1%, and that dragged down the S&P 500 as well, negative 0.5%, given that the Nasdaq 100 and the S&P 500 has a very strong direct correlation. So if you look at the chart over here, so what we could see is that this is the intraday start. Initially, there was a bounce. Then thereafter, it sell off and closed at the low. That's the S&P. If you look at the Nasdaq 100, okay, let me go back again. So hopefully it will not chart. Okay, sorry about that. So my internet connection is a bit slow today, so it's kind of lagging behind. Okay, do give it a couple of times to load. Okay, so let me push it here. Okay, hopefully it will not jump to the next page. Wow, it keep jumping to the next page. Okay, let me flash this page. So let it load for a while. Okay, you're able to see very same performance. Try to push up during the intraday session, but unable to actually maintain that momentum and sell off right exactly at the last hour close of the US session. Whereas if you look at the Dow Jones Industrial Average, okay, give a minute, let to load for a while. Okay, Dow Jones. Okay, notice that over here it went up, but at least when it comes to the close, it closed down, but still maintained a positive performance, okay, at the close. So what we could see over here is if you to look at the heat map of the S&P 500, okay, let it load for a while because I'm not sure why is it so slow today, the internet connection, because perhaps it's Friday. Yeah, okay, yeah. So very clearly, right, we'll start to see a very deep red across the one that has a bigger square. Okay, so how do you read this heat map? Is those box that's a bigger square is the mega cap stocks. That means it is heavily weighted in the S&P 500 based on their very extremely large market cap weightage. So what you could see over here is that almost all the mega cap stocks, 7 of them close in the red. All right, Nvidia continues to plunge, a negative 1.7%, and the one that is slightly in the green will be only only Tesla, up close to 2%. Whereas the rest of the other industry, I would say that is still in a pretty much healthy bit over here. But despite the fact that we know that the mega cap stocks, they have a very huge weightage on the S&P 500. So if they can't actually we call it close in the green, it will also drag down the S&P 500 index as well, despite other sector that are actually outperforming and showing in the green, but they have a lower weightage on the S&P 500 index if we are trading solely on the pure vanilla S&P 500 index. All right, so then if you look at the yesterday's FX performance over here, it's rather mixed. Okay, so if you look at the dollar index, so the dollar index continues to be trapped, trading sideways, can't really actually break out above the 200-day moving average since the whole of this week. Notice the candle body is very small, so it's kind of a congestion basis for the dollar index. That means no clear on the average. You put everything on the average together, there's no clear dollar strength or dollar weakness. But as we know that later, I'll share with you all the 5-day rolling performance chart when we break down the major dollar movement against the other currency. In the last 4 days or so, the most startlingly dollar outperformance was against the Aussie and the Kiwi, but the dollar performed very weak against the yen. All right, so there's this K-shaped scenario that I'll share with you all. But you put then everything to the average together, the dollar index kind of trade sideways, and it continues to remain kept below the near-term resistance zone of 104.88 and 105.24, which is the 20-day and the 50-day moving average. That's I think as a resistance as well. And the daily RSI continues to shape kind of a lower low right below the 50 level mark. Okay, so indicating there's no clear signs of upside momentum at this juncture, and also kind of being supported by the US Treasury yield, that both the 2-year and the 10-year continues to remain weak. So the 2-year continues to trade lower, and right now is going to retest the near-term support level at 4.42%. Okay, yesterday it attempted to have an intraday break, but there is no sign of we call it a bullish divergence yet, no clear bullish divergence. So what I could see is that it continues to trade lower and lower below the downward sloping 20-day moving average. So indicating to us that there are medium-term trends since the bearish breakdown on this ascending channel support on the 13th of June remains intact. So if you know that for sure this is the very clear downward trajectory of the 2-year Treasury yield that is dropping at this rate right now. If you look at the 10-year US Treasury yield, it continues to drop yesterday, but didn't drop far much lower in the last 1 week or so in terms of magnitude as compares to the 2-year. So this is what I call the bull steepening. That means, i.e., the 2-year is dropping faster than the 10-year Treasury yield, so causing the 10-year minus the 2-year yield spread to be sloping upward. So this sloping upward is not a bear steepening, it's a bull steepening phase instead. And why do I mean by bull steepening? Because, i.e., the US Treasury yield 10-year is dropping at a lower rate. That means indicating to us that the market participant right now is still not pricing in a hard landing scenario for the US economy, because the 10-year US Treasury yield has a very close proxy to longer-term inflationary trend in the US and longer-term growth trend of the US. Okay, but you know that if longer term starts to, if we start to see market participants starts to price in a recessionary scenario, the 10-year US Treasury will start to drop faster than the 2-year. And why the 2-year is dropping faster than the 10-year right now? They call it a bull steepening, because market participant has started to price in a higher chances of the start of an interest rate cut cycle by the US Federal Reserve, as flashed earlier on by the CME Fed Watch 2 a couple of minutes ago. Okay, so right now, if you look at over here, the 10-year US Treasury also remains a rather it shaped a bearish reaction right off the intermediate resistance zone at 4.28%, 4.33% yesterday, which confluenced with the 50-day, the 200-day, and the 20-day moving average, I think, as a resistance level as well. All right, so net, what we could see over here is that both the 2-year and the 10-year US Treasury yield is still showing some kind of softness. That actually why translate overall, we do not see a very clear dollar strength coming back into the play. If I were to look at the dollar index perspective, we put everything together or in conjunction together. So what we could see over here, right, if I were to save this chart, okay, now let me open up the chart of the that spread between the dollar against the other major pair. Okay, give me a minute. So hopefully it's able to load soon, okay, because today is a bit slow. I can't, now what I try to do is I'm trying to load up the page, so just bear with me for a couple of seconds. Yeah, okay, it's up and running. Very good. Okay, so now this is what I mean earlier on. Okay, so this is the 5-day rolling performance of the major dollar pair against the other currency. Okay, okay, so initially, right, notice there was this K shape earlier at the start of since the last 4 days session over here. Okay, let me put this up. Okay, so hopefully let me change. Okay, it's very slow, so I don't want to change. So this is not 25th, this is right now 26th of July. Okay, like I repeat, this 26th of July. The reason why I'm not changing it because it's very slow, so I don't want to waste any more time. So just as of right now, 26th of July. Okay, so what we could see over here is that we see a bit of normalization taking shape right now. That means overall, we see sideways of the dollar against the CAD, against the sterling, against the euro, against the Sing, against the dollars, Chinese yuan, and against the Swiss franc. But we have the K-shaped performance where the dollar was the weakest against the Japanese yen, but the strongest against the Aussie and the Kiwi. But we see this two outlier pair is now trying to actually converge into the average over here, right? Okay, and given that the fact that the Tokyo CPI data is mixed today, that also supports this convergence of this weakness in the dollar against the yen back into the average, and also potentially there's some intermarket spillover by systematic fund flow of the convergence of the dollar strength. That means not so much dollar strength against the Aussie dollar and against the Kiwi from a short-term intraday perspective as they inch down back towards the average over here. Okay, so this is what I want to share with you. This market play that's going right now. Okay, then with that, that's actually sum up the cross asset performance that I will share with you that has taken shape yesterday from a much more significant perspective. And with that, let us now jump straight into the medium-term intermarket dynamics that is playing out right now. So I want to focus more about the US stock market because of this very clear rotation that is taking shape. So what is this rotation? For those who have followed my daily dose on a longer term basis since the 2 weeks ago, I'll be sharing about this potential bull steepening, okay, of the US Treasury yield curve. So this bull steepening, I do not want to, let's not repeat again what's the bull steepening because I already shared with you all the definition of a bull steepening a couple of minutes ago. So we know that this bull steepening is taking shape very, very clearly, especially it get more pronounced in the last 2 weeks over here, 15th of July, and right now we are speaking right now. And the clear inflection level or the breakout point will comes at negative 0.08% from a technical analysis perspective. So if this purple line continues to break out above this level, that means the bull steepening will totally starts to unleash its much more forceful upside momentum, totally causing this yield curve inversion to totally be invalidated. All right, so previously there was a breakdown below 0% over here that was in July 2022, 2 years ago, all right, where everybody was fearful of that US Treasury yield curve inversion that potentially, if it's being unaddressed, then we're going to slope downwards. It may cause a US recession going forward. So right now, this yield curve inversion scenario is getting lesser and lesser. Why? Because this potential bull steepening is playing out. All right. So how does it impact the US major stock indices? So what we could see over here is I did the spread between the momentum ETF versus the normal S&P 500, which is this turquoise green line, and the S&P 500 value based ETF versus the normal S&P 500 index, that's the ETF, using the turquoise blue line over here, so the green versus the blue over here. So we know that since the start of 2023 and even right now going into the current year to date, the leading performance in the US stock market has been led by the mega cap stocks, which eventually see outperformance in the Nasdaq 100, followed by the S&P 500, i.e. momentum driven play. So that's why you see the momentum ETF that is highly weighted accordingly to the price action of these mega cap stocks that is actually leading the fort. That means if you to Google SPMO and open up the fact sheet of this ETF, is actually a re-rating of the S&P 500 component stock. Those stocks that have a higher momentum factor will rank at the top. And you see the top 5 or the top 10 stocks are in fact the 7 mega cap stocks. All right, with the likes of Nvidia, Microsoft, and Apple. Okay, all those stocks. Whereas those value-related stocks, like financial stocks, industrial stocks, are actually not at the top few or even the top 50 holdings of the momentum ETF. But however, those value-oriented stock or cyclical stocks or industrial stocks are actually have a higher weightage in this S&P 500 value factor ETF. So you could see over here is that since 2003 and also since the start of this year, it has been underperforming the S&P 500 by this downward sloping ratio. So if you look at this ratio right now, it actually starts to inch upwards as well. Okay, very clearly there is some form of outperformance of the value ETF or value factor S&P 500 component stocks that are actually now performing better due to much more over optimism or a higher valuation that is being seen in the mega cap stocks, and also being driven by this bull steepening as well. All right, so what we could see over here is that this bull steepening previously is also take shape previously from August 2020. So that was right after the COVID pandemic, all the way up to March 2021. So when this bull steepening takes shape, we realize that the ratio of the the value ETF also outperformed the normal S&P over at this point in time. And at that point, the momentum actually underperformed. All right, so right now we could start to see similar price action behavior occurring over here again, where value starts to outperform and momentum starts to dip lower. All right, so right now if I were to take a step back and overlay it with the Dow Jones Industrial Average, you will see very against the Nasdaq 100, because we know that the Nasdaq 100 is a top performer right now. Okay, let me refresh the chart. Okay, we start to see similar price action on the ratio as well, where the Dow Jones Industrial Average ratio against the Nasdaq 100 and the Russell 2000 ratio against the Nasdaq 100 as well. Both of these two ratio, the dark blue ratio and the turquoise blue ratio is inching upwards in the last week, 1.5 week. Okay, as we are speaking, since last 1.5 week, pardon me, and we start to see it's being driven by the potential bull curve bull steepening of the US Treasury yield curve against taking the 10-year minus the 2-year. And like I said earlier on, if you look at right after the COVID-19 pandemic during May 2020 all the way up to this March 2021, the bull steepening took shape at that point in time. And over here, we also start to see the ratio of the Dow Jones Industrial Average against the Russell 2000 inching upwards as well. Okay, showing signs of a Dow Jones and Russell 2000 outperformance against the Nasdaq 100. Okay, so now this particular two chart shouldn't be much of a foreign to you guys, for those who actually followed my daily dose of market insights. So it continued to play out. So one more chart I want to share with you, I think this is the first time I'm sharing, is I will take a step back during the dot-com bubble. So we know that there's a lot of parallel right now in the dot-com bubble right now in the performance of the US stock market. So during the dot-com bubble, everyone is talking about higher productivity that could actually drive the global economy through the emergence of new technology that actually come out from the US side of the story first. That means we start to see a lot of prominent US firm engaging in we call it the e-commerce business, they call it .com, and also at that point in time there was Internet 1.0, Internet 2.0. We require a lot of we call it a telecommunication company that is actually on the top of the value chain, like Cisco over here, to actually drive this internet connection at that point in time. So right now we're talking about AI. So AI is the forefront where potentially it could actually improve productivity growth. So there's a lot of optimism. It's just two different kind of technology that's been developed. So right now, if you look at this particular chart here, okay, so what I'm going to share with you all is a very interesting chart. Okay, this dotted line here is the peak of the dot-com bubble in March 2000. Okay, we see very clearly here. The top chart is the SPX. This one is the NDX. So both of them are highlighted in black and white candlestick. So these two group together. Those in green and red candlestick are the Dow Jones Industrial Average and the Russell 2000. Over here, this one is the Fed funds rate. Okay, the Fed funds rate. And at the bottom of this purple line here is the spread. all right, is the spread between the 10-year US Treasury yield minus the 2-year. So let me copy this over so that you guys could have a better picture. Okay, let me try to, okay, what I'm doing is I'm going to copy this thing over there. Okay, oh gosh, it's very, very slow. Okay, no, my thing is so slow, I can't copy. Just this purple line here is the yield curve spread. So don't think of it as the similar thing as the 10-year US Treasury yield minus off the 2-year Treasury yield. All right, so I can't copy the word over here. Okay, so what I could see over here is that this is the hype of the dot-com optimism. Okay, we see a spike up over here, right? A spike up. So what you could see at the end of the bubble, the peak of the Nasdaq 100 actually also correspond with the peak of the SPX. Okay, then thereafter, what we could see very interestingly, a couple of months later, the US Federal Reserve starts to cut interest rate. Okay, it cut interest rate. So when it cut interest rate over here, we start to see the yield curve steepening. That means this is the bull steepening again. So during this bull steepening over here, it's steep. Look at my cursor. The Nasdaq 100 continues to fall, right? You can see the Nasdaq 100 continues to fall. The SPX also continues to fall, but at a lesser rate compared to the Nasdaq 100. But however, the Dow Jones and the Russell 2000 remain stable. Okay, it remains stable. So it kind of goes sideways as the bull curve, as the bull steepening takes shape. All right, but the Nasdaq 100 continues to plummet lower low and lower high. Okay, so what it means that over here, right, this particular scenario could be playing out as well right now, given there is potentially a unwinding of the Nasdaq 100 top performance, shifting towards the Dow Jones and the Russell 2000. But will it lead to a very drastic potential dot-com bubble where we start to see close to a lost decade of the Nasdaq 100 thereafter over here? Okay, that means close to about, we're talking about 9 years of a decade of lost decade. Well, if you want to answer that question, potentially it seems to be much slim right now. Why? Because at the point in time, the Nasdaq 100 during the dot-com bubble situation is being driven by companies with very weak profitability growth. That means, or even there is no clear signs of profit growth as well. But however, right now, the 7 mega cap stocks that are driving this AI optimism play comes with decent profitability growth. So that is the two stark difference over here. So in terms of whether we will see a bursting of a similar 2000 dot-com bubble burst at this juncture, I would say lower odds given the current fundamentals of the mega cap stocks right now that are driving this Nasdaq 100 play. But for sure, there will be some form of rotation coming into the play. That means, i.e., I do expect some kind of very similar outperformance like what we did during that 2000 period, March 2000 to November, all the way up to stretching to almost close to about 6 or 7 months, where the bull curve steepening continues after the US Federal Reserve rate cut cycle takes shape, and where the Dow Jones Industrial Average and the Russell 2000 actually outperform the Nasdaq 100 and as well as the S&P 500. But this time around, they go more of a sideways basis at this point in time. So this time, as long as the Nasdaq 100 didn't actually plunge so low, or due to the fact that there is still some form of positive fundamentals that is supporting the current mega cap stocks versus what happened earlier in the 1990 dot-com bubble run, where the leadership is being centered by weak fundamental stocks that doesn't have decent profitability growth. So that could actually reduce the drastic unwinding of the Nasdaq 100, which will start to see potential higher high on the Dow Jones and the Russell 2000, maybe at this juncture instead, okay, given into the current context. All right, so that is the intermarket dynamics play that is playing out right now that I share with you all from a longer term, medium term perspective. All right, so with that, now let us now jump straight into the short term intraday technical outlook. So wherever I'm sharing right now is very short term intraday basis. That means good for 1 day or so. All right, so with that, now let me expand my screen so that you guys could see. Okay, Now, let us start with the FX market first. All right. Okay, so let's start with the euro dollar. So euro dollar yesterday, if we could recall, we flipped to a bullish bias. Why? Because the price action already hit the 20-day moving average, that what we intended earlier on at the start of this week, and the RSI continues to remain in a bullish momentum condition as it continues to flash out a series of higher low and staying above the 50 level yesterday. So with that, no change. We will still use the 1.0805 as my short-term pivotal support level for today, which confluence with the 200-day and the 50-day moving average. Maintain that short-term intraday bullish bias. First resistance level to watch out for 1.0880, followed by 1.090, then thereafter followed by 1.0920 level. All right, so this will be the intraday resistance level to watch out for on the upside for the euro dollar for today. However, if we see a plunge now with hourly close below 1.0805, then it will invalidate the today's intraday bullish bias on the euro dollar to see the extension of this minor corrective decline to expose the next near-term support level at 1.0770, followed by 1.0730 next. Moving on will be the cable, the sterling dollar. So yesterday we do have a bearish bias looking for the cable to retest the 20-day moving average at 1.2845. So this level has really been met, 1.28045. So with that, we will actually flip to a short-term intraday bullish bias right now, looking at the fact that very likely the sterling will start to move in sync with the euro dollar on a short-term intraday basis, given the fact that it has really retested the 20-day moving average yesterday. And also the RSI also starts to exit from the oversold level as well. So with that, 1.2845 short-term pivotal support level for today on the sterling dollar, flip to a short-term intraday bullish bias. First resistance level to watch out for will be yesterday's swing high area, or yesterday intraday high at 1.2914, 1.2914. Above 1.2914 potentially sees a retest as at this minor range congestion resistance upper limit at 1.2940. Only a clear break above 1.2940 may see a further move to test the next near-term resistance at 1.2990 level. Only an hourly close below 1.2845 will invalidate today's intraday bullish bias on the sterling dollar to resume its minor corrective decline motion to retest the 50-day moving average that is acting as a support level as well at 1.2780. A breakdown below it sees a further potential downside extension towards the 1.27 figure level, psychological level, which confluence with the former minor swing high of 25th of June and 1st of July, now acting as a pullback near-term pullback support level. All right, so now let us move to the Asia Pacific dollar pair, the dollar pair against the Asia Pacific currency. Okay, starting with the Aussie dollar. So for the Aussie dollar, yesterday it hit our short-term support level that as intended at 65.20, and right now the price action has started to actually shape a series of higher high over here. And if you were to actually do a very interesting play right now, okay, it seems to be breaking out of a resistance level as well. Okay, it broke out and now trying to actually inch up higher above the 50 level mark on the hourly RSI. So given this positive development in the momentum hourly indicator as depicted by the hourly RSI, seems to us that this down move here at the 65.20 support level, the bearish motion, at least on the intraday basis, seems to get exhausted right now. And given that this positive development in the hourly RSI, we'll flip to a short-term intraday bullish bias on the Aussie dollar to at least see some form of mean reversion rebound taking shape today. All right, on the Aussie dollar. So using 65.20 on the short-term pivotal support on the Aussie dollar, flip to a short-term bullish bias for this mean reversion rebound scenario to play out. First resistance level towards 65.80 on the intraday basis, which is the 200-day moving average. I think that's a resistance as well. Above it sees the minor swing high of 24th of July coming in at 66.10. Okay, so these are the two intraday resistance level to watch on the Aussie dollar. But however, if we start to break down below 65.20, then this intraday bullish buyers scenario for that mean reversion rebound scenario to play out will be invalidated to see the continuation of the impulsive down move to expose the next near-term support level at 64.65, which is confluence with the minor swing low of 1st of May, and as well as the 64.8 or 67.4% Fibo retracement of the low of 19th of April all the way up to the high of 11th of July, also confluencing at a similar 64.65 graphical support level, minor graphical support level. All right, so that's for the Australia dollar. Now moving on will be the dollar yen. So dollar yen, let me share with you the bigger picture chart of the dollar yen. So dollar yen over here, we share that after the breakdown of the 15650 level, the next support level to watch will be at the 15170. So what is this 15170? Graphically, is pretty key. Former minor swing high of 13th of November, and the former major swing high of the 21st of October. Or this particular lead to a drastic slide due to BOJ intervention. And over here, previously it tested, come breakout and did that slide as well. And previously, then thereafter it did a breakout. Then after there was this BOJ intervention here on 26th of June, or April, not June, 26th of April this year, or 26th of April over here. Yeah, this year. Okay, this one, let me change it. It's 2024. Okay, that lead to the sell-off, but the sell-off can't break below the 152 level or 1570 level, and it bounces. And yesterday, same, the sell-off can't break below 15170 level and shape that long-legged doji candlestick, or they call it the dragonfly doji candlestick. Some form of bullish reversal candlestick has formed on the daily basis, and it's on the daily basis, it's not the hourly basis, so it has a significant psychological impact in terms of technical analysis speak. All right, and where does it take shape? It also takes shape right at the key long-term 200-day moving average, and with the daily RSI right at the oversold region again. So i.e., with this kind of positive element that is being seen on the higher time frame chart, the daily chart over here, you could see at least there could be some form of short-term rebound taking shape back towards the 15650 level again from a multi-day perspective. All right, so now what's cooking on a intraday perspective for today? All right, so now let's look at the hourly chart of the dollar yen. So with that, for sure 15170 will be my short-term pivotal support level. Yesterday it almost came very close to it. Okay, shaped a intraday low at 15194 on 4 p.m. Singapore time. So that is the European session start. Then thereafter it tried to bounce. So far cannot break the 15410. So if we call this 15410 was the short-term pivotal resistance that we have yesterday. And also what's interesting over here, once it shaped that lower low, this lower low also formed at the low of this minor descending channel that I drew from the high of 11th of July. And we also start to see positive condition playing out on the hourly RSI. So this is short-term hourly RSI, a bullish divergence, indicating to us that perhaps yesterday low was the exhaustion point, at least on an intraday basis, for the bears of the dollar yen. So with that, I'll use 15170 as my short-term pivotal support level, flip to a short-term intraday bullish bias on the dollar yen. Potential for a mean reversion rebound to take shape first in first step. Above 15110 exposes the next near-term support at 15580, and potentially above it sees 15770 again, which is the 50-day moving average acting as a resistance. And if we were to do the Fibo retracement of this entire 5-wave down, 1, 2, 3, then this is 4, and this is a kind of a 5-wave down as well. Okay, this is the 15580 is the 38% Fibo retracement, and the 15770 is close to the 61.8% Fibo retracement over here. Okay, maybe perhaps right. This is the Fibo retracement. So let me see this center. May I just push to the right? Yeah, you can see more clearly over here, right? 38% at 15770 is close to the 61.8% golden ratio retracement, right? Only A breakdown with an hourly close below 15170 will invalidate today's intraday bullish bias on the dollar yen to see the further continuation of this impulsive down move to expose the next near-term support level of 150.80/40, 150 figure slash 14950. All right, so that's for the dollar yen. Now, moving on will be the short-term intraday technical outlook on the major stock indices, starting with the Hong Kong 33 first over here. Okay, so for the Hong Kong 33 over here, yesterday we do have hitting, so it continues to remains rather bearish over here. So yesterday we do have a short-term intraday bearish bias on the Hong Kong 33. So right now it really cleared below this support level that we have, the first support level they have yesterday, and also bearish reaction right at the 200-day moving average as well. All right, so with that, we will have a slightly tighter short-term pivotal support for today. Pivotal resistance, pardon me, not support, slightly shorter pivotal resistance for today. Tighter one at 17,270 level. Let me adjust it. Okay. All right, so as long as this tighten short-term pivotal resistance level holds for today at 17,270, we will still have maintained that short-term intraday bearish bias on the Hong Kong 33 or the Hang Seng Index. Next near-term support level to watch 16,840. A breakdown below it exposes 16,620, which is this area here. Okay, this minor congestion area of 15th of April and 19th of April. Only an hourly close above 17,270 will invalidate today's intraday bearish bias to see a mean reversion rebound to do a bit of form of upside retracement to expose the next near-term resistance level at 17,517. Above it, potentially sees this 17, this area here, 17,650. Okay, which correspond to the downward sloping 20-day moving average as well. All right, so let me delete this. Okay, so that's for the intraday technical outlook on the Hong Kong 33 or the Hang Seng Index. Now let us move on to the Japan 225 or the Nikkei 225 next. So the Nikkei 225 yesterday, we do have a bearish bias, looking for it to inch down lower. The support level to watch will be at 37,105. More or less, it already been met by this level itself over here. And what we could see over here is that very interestingly, the price action now has of the RSI has started to shape a series of higher high after hitting the grossly oversold region yesterday. All right, okay, oversold region yesterday, that's almost on a similar low that what we see earlier on 30th of May, where it actually led to this strong push up thereafter. So right now, what's interesting over here is that we do see some form of bullish breakout as well. If we were to actually do this kind of trend line, okay, it's about to shape that bullish breakout. Okay, testing this resistance line here. But what's positive is that we start to see a series of higher low that has taken shape earlier on the hourly RSI, given that some form of bullish momentum has started to build up on the Japan 225 price action, at least on the short-term intraday basis. So with that, we'll be using, given this positive, we call it development that has taken shape on the hourly momentum indicator, which is the RSI, we will actually flip to a short-term intraday bullish bias for the Japan 225, i.e. the Nikkei 225, using 37,105 as a short-term pivotal support. We saw confluence with the 200-day moving average, I think as a support level as well. First resistance level to watch, 38,750. Above it exposes 39,350, which correspond to the 50-day moving average that is acting as a resistance level. Okay, so these are the two resistance levels to watch on the upside for the Japan 225 on the intraday basis for today. However, if price action of the Japan 225 starts to inch down lower and do an hourly close and a breakdown below 37,105, then this short-term intraday bullish bias scenario will be invalidated to see the continuation of the impulsive down move to expose the next near-term support level at 36,495, followed by 35,685 next, right, which is this swing low area of minus swing low area of 26th of June and 26th of Jan and 31st of Jan and 1st of February this year. Okay, so that's for the Japan 225. Now let us move on to the European stock index, which is the German DAX over here. So the German DAX yesterday, we do have a bearish bias. It hit the lower limit of this expanding wedge configuration at 18,150 before shipping that fast and furious intraday bullish reversal. So indicating that this form of expanding wedge is still intact. That means we still got to respect its price action oscillation within this expanding wedge configuration because of the very fast and furious minor V-shaped reversal that shaped right exactly at the test on this lower limit of this expanding wedge, which is the support level at 18,150. So with that, we are flipping back to a short-term intraday bullish bias on the German 30 for this oscillation to play out towards the, at least into the middle part of this expanding wedge range configuration. So using 18,150 as my short-term pivotal support level. As long as this level holds, we will flip to a short-term intraday bullish bias. Near-term resistance level to watch in first step, 18,395. Above it exposes 18,520 next. All right. So these are the two key short-term intraday resistance level to watch. All right, 18,395, 18,520. However, if price action of the German 30 starts to break down and have an hourly breakdown with an hourly close below 18,150, then this intraday bullish bias will be invalidated and potentially we may start to see a bearish breakdown of this expanding wedge range configuration to expose the next near-term support level in the first step at 18,050, followed by 17,970 next, which is the swing low area of 14th of June and 17th of June this year. Okay, so that's for the German 30. Moving on will be the major US stock indices, starting with the Dow Jones Industrial Average or the US Wall Street 30. And given that a potential bull steepening yield curve that is taking shape right now, and yesterday we see a retest again on that 20-day moving average. So yesterday we do have a neutrality stance on the US Wall Street 30. So given that bounce that we are seeing right now on the 20-day moving average, right exactly at the previous short-term pivotal support that we have, and also yesterday's lower limit of the neutrality range at 39,890, we'll be flipping to a short-term intraday bullish bias. And also what support this bullish bias is yesterday we see similar low on the retest of that 39,890, but the RSI start to shape a higher low. So indicating that some form of bearish exhaustion at yesterday's low level of a retest of that 39,890. So with this form of a positive momentum coming into play and supported by the intermarket dynamics of that bull steepening yield curve playbook that is playing out right now, using 39,890 short-term pivotal support on the US Wall Street 30, i.e. Dow Jones Industrial Average, flip back to a short-term intraday bullish bias. But first resistance level to watch out for today on the intraday basis will be very close to yesterday's minor swing high at this resistance zone of 40,564/40,670. Only a clearance above 40,670 may expose a further potential upside to test the next near-term resistance at 41,050 on the US Wall Street 30. So this is the first resistance zone to watch out for on an intraday basis. However, if price action continues to inch downwards and shape a hourly close and a breakdown below 39,890, then this intraday bullish bias will be invalidated to see the continuation of the minor corrective decline scenario to extend further downwards to expose the next near-term support level of 39,620, followed by 39,300 level. All right, so that's also correspond to the 50-day moving average. Now moving on will be the Nasdaq 100. So Nasdaq 100 yesterday we maintained that we have that bearish bias, looking for it to actually come close to the support level at 18,650, which is so the one-time Fibo extension of this ongoing 5-wave down move. Wave 1, wave 2, wave 3, wave 4, wave 5. Okay, so this is the kind of a fifth wave extension over here at the 18,650 level, which will correspond with the one-time Fibo extension and correspond to the minor congestion area of 24th of May to 5th of June. Okay, and it's coming very close to this level yesterday. Okay, so with that, and also without, we do see a bullish divergence that also has been formed on the hourly RSI as well. So with that, there could be some signs of at least a mean reversion rebound to retrace this steep down move from 11th of July all the way up to yesterday's intraday low over here. So what we could see over here is we will have a short-term intraday bullish bias for the Nasdaq 100 for that potential mean reversion rebound to play out on an intraday basis using 18,650 as my short-term pivotal support level. First near-term resistance level to watch on the intraday basis again, 19,230. Above it exposes 19,520. So these are the two key resistance level to watch on the intraday basis, 19,230, 19,520. And if you do a Fibo retracement taking from the current 5-wave down move, from the high of 11 on July, also correspond to the 23.6% and the 38.2% Fibo retracement as well. All right. However, if we start to see the price action coming down again and have an hourly close and a breakdown below 18,650, then this intraday bullish bias scenario for that mean reversion rebound will be invalidated to see the continuation of the impulsive down move to expose the next near-term support in first step at 18,390/18,360, followed by 18,125, which is the 1.382%. 1.382 Fibo extension level, and also correspond to the minor swing low area of 10th of May and 14th of May this year. So that sum up the intraday technical outlook on the major stock indices. Now let us move on to the major commodities, starting with gold XAU/USD. Yesterday for gold, we do have a neutrality range between 2,353 and 2,386. Price action came down, hit the lower limit of the neutrality range, and managed to stage a bounce right in today's Asia session as we speak. And very interestingly, while it actually tested the lower limit of the neutrality range that we predefined yesterday at 2,353, the hourly RSI shaped a bullish divergence, so indicating some form of bearish exhaustion in yesterday's minor swing low. So there could be at least some form of a short-term rebound taking shape back into gold XAU/USD. So with that, we do have a and we also start to see a kind of a 5-wave movement down as well. 1, 2, 3, 4, 5. All right, for 5th wave down. And if you do the 5th wave projection over here, okay, it kind of corresponds to the 0.764. Okay, yesterday low close to the 0.764 and also close to the 50-day moving average as well. That's acting as support. So with this potential positive short-term element that is coming into play on XAU/USD gold, so we will on an intraday basis, we will flip to a short-term intraday bullish bias using 2,353 as a short-term pivotal support level. First resistance to watch out for will be at 2,386 on an intraday basis. Above this level, potentially takes us up slightly higher, okay, to this former congestion area here at 2,411 level, okay, this level 2,411. Okay, so these are the two key short-term intraday resistance level to watch out for today: 2,386 followed by 2,411 in this short-term potential intraday bullish bias scenario. And if you do the Fibo retracement of this entire 5-wave down, minor 5-wave down, it so correspond very closely to the 23.6 and slightly below the 50% Fibo retracement. All right. However, if the price action of the gold XAU/USD starts to inch downwards and have an hourly breakdown and an hourly close below 2,535, then this intraday bullish bias scenario will be invalidated to see the continuation of this impulsive down move to expose the 2,337 followed by the 2,323 support level next, which is the minor swing low area of 28th of June and 2nd of July. So that's for gold XAU/USD. Moving on, next will be the West Texas crude oil over here. So what's interesting over here is that the West Texas crude oil, yesterday it managed to actually bounce off close to the 200-day moving average, and at this former graphical congestion area here on the daily chart, this is the daily chart, okay, on West Texas crude oil, very clearly 78.40, 76.60 level. All right, this area over here. So what we could see over here, there's some form of bullish momentum or a price action rebound that is taking shape at this key graphical support level on the daily chart. So with that, on the hourly chart from here, yesterday we do have a bearish bias looking for it to inch down towards this support level, and given the fact that using 78.95 as a short-term pivotal resistance level, this level has really been broken out in today's yesterday US session. So yesterday's intraday bearish bias has been invalidated, and given the positive movement that was seen yesterday in the daily chart that I flashed to you all, there could be some form of mean reversion rebound taking shape on West Texas crude oil to do the retracement back into that 80.30, 81.20 level again, and even 81.95, which is correspond to the 20-day moving average, I think, as a resistance level as well. And Another positive that's being seen on West Texas crude oil was the bullish divergence that's being flashed out on the hourly RSI. So with that level over here, I'll be using yesterday's minor swing low. Okay, this level here, which is 77.10 level, 77.10. Okay, as my short-term pivotal support for today. Okay, short-term pivotal support. First support level to watch, okay, potentially will be this 20-day, 200-day moving average, now acting as a support, reacting as a support for any form of a minor pullback. So as long as this minor pullback didn't surpass yesterday's low, because this could be the minor key low area given of that formation, that bullish divergence as well. So 77.10 short-term pivotal support, flip to a short-term intraday bullish bias on West Texas oil. Next resistance level to watch on the intraday basis, 80.30 followed by 81.20. Only an hourly close below 71.10 will invalidate today's intraday bearish bias to see the continuation of the down move to expose the next near-term support on the intraday basis as well, 76.30 followed by 75.46 level. All right, so that sum up for West Texas crude oil intraday technical outlook, and as well as the intraday technical outlook on the major cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data points to look out for today? So during the European session, it will be a rather quiet session. What we have right now is the all-important core PCE price data, because this is inflation metrics that the US Federal Reserve tend to actually a preferred choice of, we call it targeting, rather than the usual CPI data. All right, so market will be focusing on the core PCE price index, the one that's stripped out of energy and food prices, less volatile, releasing at 8:30 p.m. Singapore time. So market is expecting a further dip down to 2.5% year on year from 2.6. So if you look at the trend of the core PCE, very similar to the trend of the core CPI data as well, it has been inching downwards lower and lower. So if you look at the 5-year trend, it's clearly on the path of deceleration. Okay, so market is expecting a dip down lower, 1 basis point lower to 2.5%. So as long as it didn't surprise the market over here, that means it came in at below around 2.5%. This level, this range, okay, not surprising at 2.6, 2.7 or 2.8%, then very unlikely we will start to see a spike up in the US dollar. Why? Because it's still indicating to us that if it comes in within expectation, it actually further supports the start of an interest rate cut cycle in the US undertaken by the Fed in the 18th of September FOMC meeting, as depicted by the CME Fed Watch 2 probability that I share with you at the start of today's daily dose. All right, so with that, do have a great Friday ahead, and I wish you all a great and restful weekend as well. And we shall speak again on next Monday. This is Kelvin here, signing off. Thank you.